Do crypto ETFs earn dividends? That's the big question. The answer is yes. Well, kind of. In this video, I'm going to explain how crypto ETFs generate returns, what is staking, how staking rewards compare to dividends from traditional stock ETFs, and when we could possibly expect crypto ETFs to start paying out staking rewards. With the popularity of the Bitcoin ETF launch in 2024, and then the subsequent Ethereum ETF launched later in the year, many people are wondering if these crypto ETFs earn dividends just like some of their stock counterparts. Cryptocurrency ETFs do not earn traditional dividends like stock-based ETFs because cryptocurrencies do not generate cash flows, profits, or direct payouts like stocks and dividend-paying companies. However, some crypto ETFs can generate returns in other ways. The first one is staking rewards. Some Ethereum ETFs are seeking regulatory approval to engage in staking, which allows them to earn staking rewards from validating transactions on the blockchain. Don't worry, I'll talk about what is staking in just a minute. If approved, Ethereum ETFs that participate in staking could generate a yield similar to how some traditional ETFs earn their dividends. For an example, Ethereum staking rewards currently range from 2.5% to about 7% annually. Another way that cryptocurrency ETFs generate returns is through appreciation, obviously. Most spot Bitcoin and Ethereum ETFs generate returns solely from the price appreciation of that underlying crypto asset. Another way to generate returns is through lending yield, which is very rare. Some funds engage in securities lending, where they lend out their assets to other institutional investors for a fee. This is not common yet for crypto ETFs, but could develop as regulations do evolve. The key differences between a traditional ETF and a crypto ETF include the dividend ETFs earn payouts from company profits, while crypto ETFs rely on staking if it's approved, asset appreciation, or lending yields for a potential better return. So we've been talking a lot about staking, but what is it? So let's dive into that. Staking is the process of locking up cryptocurrency to support operations of a blockchain network. And in return, you earn rewards. So when you lock up something, basically you're depositing your portion of it, and it's kind of locked up like a bond would be, or a CD, a certificate of deposit. There's a certain amount of time or requirements for you to keep those funds there in the form of that cryptocurrency. It's commonly used in a proof of stake blockchain network where validators are selected based on the amount of cryptocurrency that they stake rather than performing complex computations like in a proof of work network. So Bitcoin is a proof of work network. The nodes perform computations, basically these complex algorithms, and determine the answer. And then in doing so, they earn rewards, but there's no staking built into the Bitcoin network. And that's why the Ethereum network and the Ethereum ETFs are so important for this concept. So how does staking relate to Ethereum's proof of stake mechanism? Well, Ethereum transitioned from a proof of work to a proof of stake with Ethereum 2.0 upgrade. This happened in 2022. Under this new system, validators replace miners. Instead of miners solving cryptographic puzzles, validators are chosen to confirm transactions and secure the network based on the amount of Ethereum that they stake. Earning rewards, validators are receiving staking rewards currently about 3 to 7% annually for securing the network. There are slashing penalties, and this is what's important. Just like with Bitcoin and the reason why it's such a solid network, there's got to be a penalty if those operators or those stakers do something to negatively impact the network. So in the Ethereum's case, if validators act maliciously or go offline and they can't perform their duties, they can lose a portion of their staked Ethereum, which is their penalty for doing that. So why does staking matter for investors? Well, investors can stake Ethereum directly currently. It requires about 32 ETH, which is about a $65,000 price tag at today's prices, or through staking services and ETFs, if they're approved. Staking offers passive income, similar to earning interest or dividends. Ethereum ETFs are seeking approval to participate in staking, allowing ETF investors to potentially benefit from staking rewards. Let's talk a little bit about how crypto ETFs compare to stock ETFs. Staking rewards from Ethereum and dividend distributions from traditional ETFs are both mechanisms that provide investors with periodic returns. However, they differ in structure, sources of yield, and associated risks. With regards to the dividend distributions from the traditional ETFs, the dividend-focused ETFs invest in companies that regularly distribute a portion of their profits to shareholders. The yield from those ETFs varies based on the underlying assets and market conditions. A couple examples is Invesco's Premium Yield Equity REIT ETF, KBYW. It's focused on real estate investment trusts, and this offers about a 8.87 dividend yield. There's also the FTSE All-World High Dividend Yield Index as of the end of 2024, and comprised of about 2,370 companies, and the average dividend yield was 3.7%. Now let's look at Ethereum staking rewards. Ethereum's transition to that proof of stake consensus mechanism allows Ethereum holders to participate in network validation by staking their tokens. In return, they earn rewards proportional to their staked amount. The current estimated reward rate for Ethereum staking varies by platform. Coinbase, for example, offers an estimated annual reward rate of 2.47% for Ethereum staking, while Kraken, which is another platform, provides staking rewards ranging between 2.5% to 7% annually. StakingRewards.com, they report an estimated or an approximate annual staking reward of 5.66% for Ethereum. So in comparison, high dividend ETFs can offer yields ranging from 3% to over 8%, depending on the specific fund and the market conditions. Ethereum staking rewards also vary, with current estimates between 2.5% to 7% annually. This is influenced by factors such as the total amount staked and the network participation. So there are some risk factors we need to talk about. Dividend yields from ETFs are subject to the financial health of the underlying companies and the broader economic conditions. High yields may sometimes indicate more risk, especially if companies are under financial stress. For Ethereum staking rewards, they depend on the stability and the security of the Ethereum network. Participants must also consider technical risks, such as the validator downtime. Basically, these nodes, these computers, if they're not up and running all the time, they're not potentially going to get all of their staking, or they're going to have that staking reward slashed, as mentioned before. Or there's potential penalties for improper validation. So liquidity and accessibility are two important factors. ETFs offer high liquidity, allowing investors to buy or sell shares during market hours. Ethereum staking may require locking up funds for a certain period of time, depending on the staking method and the platform used, which potentially affects the liquidity or the ability for you to take out your money when you want. So when can we expect to have staking rewards in the crypto ETFs? Well, recent regulatory developments in 2025 have significantly impacted the potential for Ethereum ETF holders to earn returns from staking. For some background context, in May of 2024, the SEC approved spot Ethereum ETFs but prohibited these funds from participating in staking activities. This restriction prevented ETF holders from earning staking rewards, which typically yield around 3 to 4% annually. In recent developments, in February of 2025, several ETF issuers submitted amended applications to the SEC seeking permission to incorporate staking into Ethereum ETFs. Notably, CBOE filed an amended 21 shares spot Ethereum ETF to include staking, and NYSE Arca made a similar request for Grayscale's Ethereum ETFs. And on March 11th, 2025, CBOE BZX Exchange filed a proposal for the SEC to allow staking for Fidelity's Ethereum ETF. Whew, lots of acronyms there. If approved, this would enable the fund to stake its Ethereum holdings, potentially enhancing the returns for investors. So what's the impact to ETF holders like yourself maybe? Well, it's more returns, enhanced returns. Approval of the staking within Ethereum ETFs would allow investors to earn additional yields from staking rewards. It's an estimated 3 to 4% annually. That's on top of the appreciation of the price of Ethereum as the underlying crypto asset. There is some regulatory oversight that takes place, which obviously is to be expected with such a change. Incorporating staking into ETFs would subject these activities to SEC regulations, potentially offering investors greater protection and transparency. Allowing staking in ETFs could also increase demand for Ethereum, as more investors might be attracted to the combined benefits of both the ETF and the staking rewards. So the SEC's decision to permit staking in Ethereum ETFs will depend on the assessment of the associated risks, including counterparty risks, custodial relationships, liquidity concerns, and much more. In summary, the evolving regulatory landscape of 2025 does indicate a potential shift, most likely, to allowing staking in Ethereum ETFs, which could provide ETF holders with opportunities to earn staking rewards and just earn more money from their overall investment. So here's some of my personal takes on all of this. I think it's really exciting, honestly. A lot of people invest in ETFs for the dividends because they like to see the reinvesting of those dividends to start growing their portfolio year over year. Because if you're just looking at the appreciation of the stock prices of the underlying assets and there's no dividend, then basically you need to have those companies return year after year, versus having a dividend payout allows for that additional compounding of that return. I think the same thing is going to happen with Ethereum and other ETFs that have the ability to do staking and those staking rewards. Bitcoin, there might be some things that are going to be offshoots from it, but because of the Bitcoin network is not a proof of stake model, there will have to be other considerations. So Ethereum ETFs will offer that additional benefit, which some people might really want to move towards. I think it's going to be a benefit to not only Bitcoin ETFs, but also Ethereum ETFs and these future ETFs that are going to be coming out for other cryptocurrencies. It's just a really positive sign overall for the market. If you like the idea of investing in cryptocurrency ETFs and you want to minimize your taxes, then you should probably watch this video next to learn about how to unlock the full potential of your Roth IRA with digital assets. Until next time, thanks for stopping by. Hit subscribe, hit the like button, drop me a comment, let me know what you think of this, and let me know if you're excited about investing in the Ethereum ETFs once staking's allowed.